How do I open up an IUL? My name is Daniel. I've started 28 IULs with 3 different companies. Here's how. First is you have to determine the bucket size. That's how much premium is going to go in, and the plan for how you're going to put that in. Generally, there's going to be 2 different ways you're going to do that. One is going to be with monthly or annual amounts, and the second is going to be a lump sum, although it can also be a combination of these 2 things. If you're just funding with a monthly amount only, you're going to want to come back to this step once you have your policy papers in hand and make sure that the total amount you're putting in on a given year equals the guideline level premium. That's the GLP. Sometimes it's called the guideline annual premium. If it is not that number, for example, if the guideline annual or guideline level premium is higher, your policy is not structured correctly. If you're putting in a lump sum, so for example, $500,000, then your guideline single premium should be $500,000. If it's a mix of these 2, it's going to be a little bit different, but these are some good guidelines to go by to check. The reason though that this matters is because when you are opening an IUL, you want to make sure that the most money possible that you're putting in goes towards the cash value, and the least amount possible goes towards the death benefit and the cost of insurance. For example, if you're just putting in $500 a month, it is up to the agent to structure the policy to where maybe only $50 or so is going towards the cost of insurance and $450 is going towards the cash value. Now they can structure this incorrectly and give you too much death benefit and make it to where $200 is going towards the cost of insurance and only $300 goes towards the cash value. A little warning there, when the agent does that, they are paid more. And the only way this works out better for you, well, is if you pass away early because you have more death benefit. You want to make sure that's not the case. Here's a little example. This is my own personal policy. I planned to put in $1,000 a month or $12,000 a year. So I can check on my very own policy pages here. You see guideline level premium is $12,000. Since I was putting in $1,000 a month, that was exactly what I wanted it to be. The guideline single premium here was $53.9 thousand. That didn't matter as much to me because I was just funding on a monthly basis, but you actually do have some flexibility. In fact, I ended up putting in a little bit more than that 12,000. I put in 17,000 in the first year, and that's because I decided to switch to funding this with a lump sum, which you usually do over a couple years. Don't need to understand that, but you can just understand there's some flexibility. Once you've determined how much money you're going to put in and how frequently you put it in, you want to determine your death benefit. First, you're going to have to determine if that's a level or increasing. And if you're confused about this, just ask questions. Agents are able to run an illustration or multiple of them to show you when you're putting the money in and the projections for the growth. If you're not sure to do level or increasing, your agent should be. If they're not, that's probably a problem. But even if they were and you just wanted to understand, but you didn't know why they were doing what they are, just ask questions. You can also ask for multiple illustrations, because if you're not sure, well, why was it level and not increasing for me, but it was increasing and not level for him? Well, if you look at a bunch of illustrations, you can just see, oh, okay, well, 20 years into the future, I see that when I ran it at increasing, it was a little bit higher for me, but when he ran it at level, ended up being higher for him. So when in doubt, you can just have them run multiple different illustrations for you, and that way you'll be able to know, all right, now I know why it was increasing or why it was level. Usually it's going to be increasing if you're funding with a monthly amount, and it's going to be level if you're funding with a lump sum, but not every single time. Now, once you have that sorted, next is you're going to pick a company and a product to fit the goals that you have. Different products are designed for different goals. Usually, if you're going to be taking tax-free income, there's certain products that are going to be better with different loan provisions, and even companies that just have some better guarantees. So for example, if you're starting a policy for a child, you might go with a policy that guarantees bonuses after the first 15 years. If you fund the policy as planned, that could be a big deal for a younger client. Now for an older client, that might not be as important, but the early surrender value might be more important to you. So those are a couple things that you'll be looking for. And then the main things though is a company that has a high Comdex score. That's just a rating of the health and stability of the insurance company, especially related to a lot of the other ones. So if you're not in the 90s, maybe not the best choice. It's not the end of the world if it's not the case, but it's probably a good idea to have a high Comdex score since you can choose from so many different companies. From there, I like personally a company that is mutually held. They have more incentive towards you, the policyholders, as they do to the stockholders. This means when it comes to cost of insurance, when it comes to the caps and participation rates on the indexes you're linking to, they have more incentive to keep those healthy and not get into this vicious cycle of lowering the cap rates on products that they just sold to you so that you're not going to earn as much money, so they can drive that extra money towards marketing spend, towards advertising new products with higher caps, and do the same thing over and over and over again. Unfortunately, there are companies that have a history of doing this. You really don't want this to be the case. So that's why the last thing here is a company with a good history for cap rates, participation rates, making sure that they've held them or maintained healthy ratings throughout their history of having these products, and even not even just a history of keeping the cost the same, but there's actually a select few companies that have a history of lowering these costs and treating older policyholders well. So that's an important one, not one that you want to skip over or just dump into a policy with any company. From there, you have the product, you have the company, you have how much money you're going to put in, you have the death benefit size. It's time to actually apply for your indexed universal life policy that you're going to maximum fund. You're going to have to go through some paperwork. This can be a little tedious. It's usually going to be 30 minutes to an hour of going through information. The more you have your information there and prepped and you're on top of it, the quicker this process is going to be. Now, eventually, you're going to be able to sign these documents electronically, sent to you via email, some do via text, and then you are going to wait for a rating from the company. A lot of the time, you're going to have a medical exam, especially if you're putting more money in compared to less. Not always, though. You don't always need a medical exam, especially for me, for example. I did not need one. A young guy, very healthy. They see my record, they don't have anything to question. If you're older or putting more money in or in worse health, you might expect a medical exam, but this is all for your own benefit. A lot of the time, people don't want a medical exam because they think they're just in fine health, they're gonna get a standard rating, but they end up taking a medical exam and then end up getting a preferred or even better rating. After you do that, you're just gonna be waiting to hear back from the insurance company. Now, this can be a lengthy process. They do not rush people into these policies. So as tedious as it is, or sometimes frustrating, it's actually reassuring to know that this is a very serious process that they take their time with. Can be anywhere from 14 to 90 days. Just depends on how many follow-up questions they have. For example, maybe you had a hospital visit 3 years ago. They might ask some questions about that. They might want to do a telephone interview to ask you some questions personally. The main thing here, even though it says 14 to 90 days, is just number one, being patient, and number two, being on top of the things that the insurance company needs from you. So if they ask you questions, usually it should be your agent or the agent's back office that's reaching out to you, is making sure you're on top of that. Hopefully the agent is keeping you up to date on what's going on so you can always know where we stand, what we're waiting for next, what the next step is, and what you need to do, or if you're just sitting in the limbo state and just need to be patient. Finally, you'll hear back from the insurance company. If you are approved, you'll be able to begin funding the policy. And even if you're not approved, it doesn't necessarily mean this is the end. Sometimes if someone can't qualify, which is pretty rare, usually if you are unhealthy, you can still get a poor rating, but still have this function and get similar rates of return even to a healthy 18-year-old. But for whatever reason, if that wasn't the case, sometimes you can use a different person, like a spouse or a kid, to be the insured, and you can be the owner and still use this policy for the living benefits for yourself. So you're funding the policy, whether starting with monthly amounts, maybe you're doing a lump sum. For example, if it was that $500,000 and you are putting in $100,000 over 5 years to get in that full $500,000, this might mean you're sending in a check at this point. So you'd be mailing in a $100,000 check, waiting for them to cash that, and then the policy would officially be started. Your money is in there, it's going to link to the index, and you're up and running. So once you're funding the policy, the main thing here is you just need to be patient and let the money grow. If you're doing Index Universal Life, hopefully you do understand that this is a long-term vehicle. They are front-loaded with fees in the first 5 to 15 years, depending on the company and product you go with. Just like the interest on a mortgage up front, same deal with these cash value life insurance policies. Hopefully you are in this for the long run, and if you just don't understand the early year fees, we always recommend that someone is running an annual cost summary report. Number one, so you can see all of those fees down to the dollar the insurance company shows you, and then also running an internal rate of return report. This way you'll be able to see if you don't understand any of the fees, where they're coming from, where they're going, what's happening to your money, you can just look at your internal rate of return report and see, oh, okay, well, if I was gaining a 7% rate of return before all fees and before all costs, this tells me what my internal rate of return was retroactive back to day one, and you have that number. So now you know how your policy is performing and the net amount of fees that are going out of the policy. Now that the money's growing, you can use Index Universal Life like it's meant to be used. You can enjoy tax-free access. The money grows tax deferred, of course, but you can pull out the money tax-free via policy loans or withdrawals up to everything you put in. When you pass away, thankfully, the money transfers income tax-free. Remember, the most important part of this video is where I went over the policy has to be structured correctly to where the most amount goes towards the cash value and the least towards the death benefit. Almost 97% of Index Universal Life policies are not structured to where this is the case. Whether we want to attribute that to greed from the agent earning more money or just simple ignorance from most agents, even people who are well-meaning, this can be detrimental to your policy if it's not structured correctly. You really want to make sure you take your time with this. It's not just someone that you like, but it's someone that you know knows their stuff and you trust to help you out. It's not difficult to do, but it needs to be done correctly. And there you go. If you have that, you have all the pros we listed before. The money's growing tax-free. You're never going to have to worry about taxes again. And you've completely opted out of market volatility. If the S&P 500, for example, is the index you linked to, and it drops 40% like the early 2000s or in 2008, you're not going to lose a dime because of that. You can be at peace with your finances. If you'd like to take a look at what a policy would look like for yourself, how much tax-free income you might be able to take, book a 20-minute quick consult with myself down below. I'd be happy to help out.